Joining us now with her playbook is Kathy Jones, Charles Schwab, Chief Fixed Income Strategist. Kathy, Citi is abandoning the muni business, but should investors abandon munis?
Oh, absolutely not. There's still pretty attractive yields if you're in a higher tax bracket. Now, obviously, the yields have come down a lot, and they've actually come down relative to treasuries because demand has been very high. But nonetheless, we still think for somebody in a high tax bracket in a high tax state like New York or California, muni could still make a lot of sense for those investors.
Are we likely to have the same kind of bond market volatility in 2024 that we did in 23? I mean, after a really rough 22 for bond prices, I think folks expected more stability than we got.
Yeah, we're not looking at a lot of stability, at least in the first half of the year for the bond market. But having said that, volatility is both price up and price down. It isn't just price down. So we do think there'll be volatility because there's still a great deal of uncertainty around the Fed's reaction function. We saw that today with, last time Powell talked, everything was rosy. Then a couple of people come out and say, well, maybe not, maybe not so much. So I think that the Fed's reaction function will be something that people react to and causes volatility, even though I think the overall trend in yields will be lower this year. A lot of bouncing around is likely.
So help me understand how bond investors should strategize in this environment as we head into 2024. There's always the question, should I buy individual bonds? Should I buy bond funds? How much risk am I taking on if there's leverage in the bond funds?
Yeah, so, it's not an either or choice. A lot of people will do both. So if you can have enough money to create enough diversification, then individual bonds give you some advantages because you know exactly when you're going to get your principal back at par and what interest payments you're going to get. Barring a default, you have a lot less uncertainty about what the yield's going to be on your portfolio and what the outcome is going to be. But sometimes you don't have enough money to get diversification with individual bonds, so you go to a bond fund, which I think is a perfectly reasonable solution. You'll get professional management. And you'll get a lot of diversification for every dollar invested, but you're likely to get a lot more volatility in the net asset value. Is something you have to prepare for. As for leverage funds, you really have to be careful, especially with an inverted yield curve. So a lot of the leverage funds will borrow short and invest long, and with an inverted yield curve, that's a much more challenging situation to be in. So I'd be particularly cautious with leverage funds.
Right. That ends up hurting your payout. Finally, sometimes investors can miss the forest for the trees. And I wonder, looking out, say, 3 to 5 years, what is it that we're going to kick ourselves for not doing in fixed income if we were too focused on the daily and weekly moves in prices and in yields?
Well, we've been saying for most of the past year that this has been an opportunity to lock in some attractive yields for the future. And not just cash flow, right? We're not talking about any magic or even capital gains. Just if you can lock in yields of 4 to 5% for a 5 to 10 year time horizon with very little credit risk, that's an attractive proposition. It's something we really haven't had for over a decade. So I think what you look back and kick yourself on is, oh, I didn't take advantage of those yields when they were higher.
Right. It'll be the version of the mortgage that you wish you had gotten a couple of years ago. Kathy, thank you.